How banks create money from nothing, financial reserves. Many people think that banks only lend the money that people deposit in them.
In reality, modern banks can create money through a system called fractional reserve banking. This is often described as creating money from nothing, although it is done under legal rules and central bank control.
What is fractional reserve banking? Fractional reserve banking means that a bank is required to keep only a small fraction, percentage, of its total deposits as reserves. These reserves are kept either as cash in the bank or in the central bank. The rest of the money can be lent to other people. For example, if the reserve requirement is 10%, the bank must keep 10% of deposits and can lend 90%. How money is created step by step? Let's understand this with a simple example. A person deposits 100,000 rupees in a bank. The bank keeps 10% equals 10,000 rupees as reserve. The bank lends 90,000 rupees to another person. That person spends the Rs. 90,000, and the money is deposited into another bank. The second bank keeps 10% equals 9,000 rupees and lends 81,000 rupees. This process continues again and again. Although the original cash was only 100,000 rupees, the total money in the banking system becomes much larger due to repeated lending and depositing. This is how banks create new money in the form of bank deposits. Is this really money from nothing? Banks do not print physical cash. Instead, they create digital money in accounts when they give loans. When a bank approves a loan, it simply adds numbers to the borrower's account. This new money did not exist before. So, in practice, most money in the modern economy is created by banks, not by governments. Why do banks use this system? Fractional reserve banking helps grow the economy, provide loans for business, houses, and education, increase investment and jobs, make better use of idle money. If banks kept 100% of deposits and never lent money, economic growth would be very slow. What is the role of the central bank? The central bank, like State Bank of Pakistan, controls this system by setting reserve requirements, controlling interest rates, printing physical currency, regulating banks. This prevents banks from creating too much money, which could cause inflation. Risks of this system. Although useful, this system has risks. If too many people withdraw money at the same time, a bank run can happen. Too much lending can cause inflation. Bad loans can lead to financial crises. That is why banks are strictly regulated. Conclusion. Banks create money through fractional reserve banking by keeping only a part of deposits as reserves and lending the rest. This process multiplies money in the economy and supports economic growth. Although it looks like money from nothing, it is actually a controlled and regulated system that keeps the modern financial world running.